Hi Charlie, welcome to the 60th day of my video polling experiment where I break down and analyze the LinkedIn poll that I posted last week and that closed this morning. Last week's question was trying to capitalize on the fact that the stock market is a bit rocky right now and people are concerned about it, which means they're paying a little more attention to the stock market than they would during, say, a time of immense gains. The question was, do you try to time the stock market? There were three answer choices: yes, no, and sometimes. Now, this poll question got 71 votes, which is quite a good performance, but it is slightly below my average of about 80 to 85 votes per poll, perhaps because this poll is very much financially oriented, and not all of my regular voters are in the financial services industry or are very familiar with stock market terminology, such as trying to time the market. Anyway, 11% of these 71 voters said that yes, they do try to time the stock market. They try to purchase their securities at the best possible price, even if that means trying to anticipate slight declines in the price so they can purchase at a more affordable price point rather than just taking whatever the market gives them at a particular second. 63% of these voters said that no, they don't try to time the stock market, they just try to be in the stock market to be able to capitalize on those gains. 25% of my voters said that they sometimes try to time the stock market. Now on to some statistics about the stock market. A $1 investment in U.S. equities in 1900 would grow to $107.4 thousand by 2024. During this time period, U.S. inflation has averaged 2.9% annually. This means that $1 in 1900 has the same purchasing power as $37 today. As for annualized returns on particular asset classes over the past 125 years, inflation has of course been 2.9%, but Treasury bills, which is short-term bonds issued by the U.S. government that are considered risk-free due to the low default risk of the U.S. government, had an annualized return of 3.4% over the past 125 years. Bonds, which are longer-term debt instruments issued by the U.S. government, had an average annualized return of 4.6% over the past 125 years. Because if you purchase a longer-term bond, you are taking on more risk and you should be compensated accordingly. Equities, which are even more risky than T-bills and bonds, have an average annualized return of 9.7% over the past 125 years, but they are also significantly more volatile than T-bills and bonds, because there's always a chance that your company will do badly, that they'll go into bankruptcy, that they're going to have competitors eating away at their market share. So it's just one of those things where you have to ride out the volatility. Even if you are investing in an index fund or an ETF, the market can go through turbulence, and it's possible that your investment account could decline by up to 30% or even 40% in a single year. And it's up to you to kind of have the psychological fortitude to weather and ride out that decline so that you can participate in the upswing when it inevitably, at least according to historical data, occurs. Anyway, Charlie, I just wanted to clarify that none of this is investing advice or financial advice. If you want either of those things, please consult a licensed financial professional who knows what they're talking about. I'm literally just reciting statistics that I found on the internet and analyzing a poll distribution that I posted on LinkedIn. So anyway, Charlie, thank you for listening to my spiel. And before I go, as always, I will show you the poll as it appears on the LinkedIn website, just to prove that I'm not making this distribution up out of thin air. Here is the poll as it appears on LinkedIn. As you can see, it has 71 votes. No, not trying to time the stock market is the most popular answer choice with a whopping 63% of the votes. But I'm glad to see that all of the questions were selected by at least, all the answer choices were selected by at least a few of the voters, which is always good to see. We like variety in our distributions. It makes it more interesting to analyze and more realistic in terms of real world representation of, opinions about specific subjects. So I'm glad to see. Anyway, Charlie, thanks again for listening to my spiel about timing the stock market. I know that it might not be the most exciting topic for you, but considering how rocky the stock market and U.S. economy has been lately, it's certainly a very relevant topic for many people, even if they would prefer to just try to ride out the volatility and not think about it too much, because it's stressful and you have a limited amount of control over what goes on in the markets and the economy. So anyway, Charlie, thank you so much for listening so attentively, and stay tuned tomorrow for my 61st video poll analysis. Thank you for listening and have a wonderful day.